It is Mortgage 101, your guide to homeownership with Clinton Wilkins and myself, Todd Veinotte. And Clinton, tell me about fixed rates, because this is something that the rates and the variable rate debate you and I have been having now for quite a long time. But first, let's talk fixed rates.
I mean, the great debate is continuing, Todd,
yes,
honestly.
Yes.
And I think there's even more pressure on what's going on with the rates right now. We are in basically an inverse situation where the fixed rates are lower than where the variable are. Yeah. That's been going on now for a few months, okay? The longer we're in the situation, more and more people will take a fixed rate just out of nature.
Right.
It's lower, I'll take it.
Right.
Lower doesn't mean better necessarily.
Right.
A lot of clients that we're talking to, we really have to get an idea about what their risk tolerance is.
Right.
And their risk tolerance, sometimes is high. Their risk tolerance is sometimes low. And, we really have to do an assessment based on, where they are at in their life on what the best kind of term and rate is.
How do you determine that?
I think it's tough.
Yeah.
I think you have to look at their income, their assets, and their credit. Some people are forced to take a fixed rate right now that might have been traditionally taking a variable because they can't qualify on the variable.
Right.
Because it is harder now to qualify on a variable than it is on the fixed.
Why?
Used to be the other way around.
Why is that?
Because we have to qualify on a rate of 2% above the contract.
Stress
test.
Yeah. Exactly.
So the fixed rates are lower, so it's easier to qualify.
Yeah.
So it doesn't necessarily mean that everyone's running and just taking 5-year fixed willy-nilly. I will say they are the lowest. So taking a 5-year fixed is lower than a 4, 3, 2, or a 1. The shorter terms are higher. 5-year is the lowest.
Right.
Some people have to take a 5-year because the rate is lower than the shorter terms. They literally don't have any other choice. This is all they can qualify for, and here you go.
Right.
Okay? There's not really a lot of discussion then.
Yeah.
But for those borrowers that can qualify on any rate or term, then it really does open up that conversation. If clients are taking a fixed rate, sometimes I'll offer a 3-year.
Right.
If clients are comfortable. Some people just want to have a longer term just to know that they know what they have. Yeah. They're okay. They understand it's going to cost them some money, but they have the predictability, stability, payment certainty that really is involved with a fixed rate.
Right.
But 3 years are more popular now than they probably ever have been. We're going to be over the hump by then.
Right.
Yeah, the rate's high, but they can deal with it for a couple more years. No big deal. We know it's going to be high all year. So 3 years more popular. But the borrowers that are not sure what they're doing, the borrowers that may want to break their mortgage early, the borrowers that are savvy enough to be like, ooh, I'm going to convert it into a fix when the rates go down again.
Right.
Those borrowers are taking a variable.
Yeah.
To break the variable, 3 months interest.
Right.
That's very attractive.
It's very attractive.
That penalty will definitely be less than you breaking that fixed when the rates go down.
Yeah.
Okay? So that's important to know.
Right.
You can also convert your variable into a fixed rate at any time with no penalty for at least your remaining term. So maybe you ride your variable out for a year or 2 years, then you convert it down the road into a 3-year, 4-year, 5-year.
So when you convert, do you can then pick a 5-year term at that point?
You could. You could go up to a 10-year term with many lenders.
So the nice thing with the variable is you say, I'm going to float around until that rate gets to where I want at that 5-year fix, and then I'll pull the trigger on the 5-year fix.
100%.
So if you don't like where the fixed is right now, then take the variable, perhaps pay a little more if you can afford it with the stress test, and in 3 years when that fix is down, then you can pull the trigger then.
Maybe, Todd, the rates will be down in a year.
Right.
I think that's what we also need to remember.
Yeah.
That's where it's really hard to know. We don't have a crystal ball. I believe in a variable. I'm in a variable now. Yeah. Is it costing me more money than if I have a fixed? Yes. But over 5 years, will it be lower? Yes.
Yeah. Yeah.
Variable is variable because it goes up and it goes down, but we have a very short-term memory.
Right.
And I was even looking back at, I've been doing this 17 years.
Yeah.
I remember when I started in 2006, fresh out of university. I was doing mortgages on a 5-year fix at 6.25%, and the variable was somewhere around 5.95.
Right.
Because people were getting like prime minus whatever, and then doesn't the prime rate go down to 2.25%?
Wow.
And I remember I had mortgages for brothers. I had one in a fixed rate and one was in the variable. The variable, I think, had gone down for them to like 1.35%.
Mm-hmm.
And Like we still talk about it today.
Yeah.
One was at 6.25. They wanted to do the conservative method. Another one took a slightly lower variable, riskier, but then it paid off.
Yeah.
Right now, is the variable paying off? No. But will it over the period of your term? Likely yes. But again, we don't know what's going on with the world. Did we think there was going to be a pandemic? Did we think there was going to be, what was going on in Russia and Ukraine? And did we think inflation was going to be a runaway train? I don't know.
Right.
We didn't think that.
Right.
What's interesting, we touched on it earlier in our show, what's going on in the U.S. Is that going to bring those bond yields down? Is it going to help with inflation? Is it going to provide that much uncertainty in the marketplace that the cost of borrowing is just going to come down? It might. It's too early for us to know, but obviously we're going to continue watching this every day. Like we're going to report this. We'll be on with you on on the radio and we'll talk about it. It's really interesting, and I think everybody's situation is different. Everybody's risk tolerance is different. And that's why I think us asking these questions, very, very important. And I don't sit in people's households. So you need to know what your finances look like. You need to know your income and your credit and your assets. And can you weather the storm? In many cases, people can. And we've actually called every single client that we've had in a variable rate. We've been doing calls for 2 months basically now. And I've been doing a lot of check-ins. How are people doing? Some people are choosing to do transactions to refinance, do a longer amortization, and some of them are choosing to do another variable.
Right.
Some are choosing to convert into a fixed in terms of a transfer or moving them from lender to lender. And many customers that are really in these deep discounts at like prime minus 75, 100, 105 below prime, or 110. Sometimes there's even lower rates out there. They're choosing to weather the storm because they're like, Clinton, why would I convert into a fixed at something, 50, 75 basis points lower than what I have now?
Right.
That's foolish.
Yeah.
And walk away from my great discount. I'm going to ride out.
So if somebody's in the midst of a variable, that they can go to a fixed and renew that to a 5. There's no need for credit checks or any of that stuff.
As long as you're with your existing lender, you can just do a conversion.
Right.
But you need to take a minimum of your remaining term or longer.
Yeah. Right.
That's the kicker.
Right.
And typically when lenders do a conversion, they're probably not offering you the biggest discount ever because you're not new anymore.
Yeah.
They're probably going to give you something closer to that posted rate. So you need to be very educated and savvy to do a conversion. Don't race in and just be like, yes, I'll take whatever you have.
Yeah.
This is going up.
Yeah.
Some people did it, and I am fearing in a year or so, they're probably going to be unhappy that they took that 5-year fix.
Yeah,
right?
Absolutely.
But when you're in a contract, it is what it is.
Yeah. So there's so much to know here. And if people want to know more about what you're doing, or they want to watch some more of us through your social media platforms or whatever it might be, direct everybody to All Things Clinton Wilkins and where they can find more of this kind of content.
Yeah, check us out online at teamclinton.ca/radio.
Right.
It is the resource. We have lots of great content on our website, links to all our social media. We even have a TikTok. Todd and I are on there, little clips of our show. Check us out. And we'd love to hear from you. Send us a note. If you have a question, you don't even need to be a client. Send us a message, and we'll look into it. We'll give you the advice. And, we love home ownership. We love helping people. We love giving it advice. And, thanks for listening.
Absolutely. Clinton Wilkins, always a great pleasure, my friend. Thank you so much.
Thanks for having me, Todd.
That is Clinton Wilkins. I'm Todd Veinotte. Mortgage 101, your guide to home ownership.
If you've liked what you've heard and you want to learn more, feel free to visit us online at teamclinton.ca.